Personal finance is so simple. Give me just a few minutes of your time and I'll have you ready to set up your financial future today.
Raise your hand if you want to get rich.
It sounds like a get-rich-quick scheme.
Yes, thank you. You will get rich quick. We all will.
I've got a degree in finance, nearly a decade in the banking industry, and I've passed the financial advisor exam. I don't say any of that to flex on you. I just want you to know that I'm qualified to tell you that you can do this. You can manage your own money. I'm going to show you how. The financial services industry is built almost entirely around convincing you that personal finance is a complicated matter, so that investment advisors can charge you 1 to 2%
Money, please.
to manage your assets. I'm here to tell you that it's really not that complicated. It gets lumped into things like law and accounting and then finance. Law, yeah, get a lawyer. Don't try to do your own casework.
Kaboom! You've been lawyered.
Accounting, if you need some help with your taxes, hire an accountant. They really know what's going on with tax law, and it's very, very complex. The dirty secret in the finance industry is that active professional money managers actually underperform the broader market more than 50% of the time. And then the ones who do beat it one year often are not able to replicate that performance year over year.
Nobody knows if the stock is going to go up, down, sideways.
So what you're doing is paying somebody a fee to underperform the market on average. You stop giving your money to these professionals. You can really do this yourself. And I'm not giving you a tip here that's like, cut your own hair to save a little bit of money. Managing your own money can save you tens to hundreds of thousands over the course of your lifetime. Investing also isn't like, going to the gym, as I've heard it compared, where you have to make a dedicated practice day after day after day. This is something that you can set up once and set up well, and then forget about it. So if you're still thinking, I'd rather just pay somebody to do this, that's fine. Go ahead and click out of the video. No, really, go ahead, I'll wait. As a matter of fact, I'll go ahead and do a scene change while you're doing that. Thanks for sticking around. Now we're going to talk about the 4 things you need to know to manage money on your own. The first thing you're going to want to do is minimize your expenses, and this can be done in 2 ways. First, you can minimize your tax burden, and you can use special accounts to do this. Accounts like a 401k or a 403b through your employer allow you to allocate pre-tax dollars to your investments. That means you take a chunk of your paycheck and send it to the 401k, and you don't pay tax on that money in the year you earn it. You pay tax on the money and the gains in the year you withdraw it. For those of you without traditional employment or W-2 employment, you can use what's called a SEP IRA or a self-directed 401k. These are going to be a little more situation specific, and I'd suggest you consult with an accountant on this one to make sure that you know which one is best for your individual situation. The other type of account is called a Roth IRA, and this allows you to invest dollars that you've already paid tax on, and then when you withdraw them, there's no tax on the gains you take out. This is an extremely powerful tool to grow your money over time and then withdraw all of that invested gain tax-free. Each of these accounts are going to have specific limitations on how much you can put into them each year, so be sure to check on that before you allocate money, but those change year to year, so I don't want to throw a hard number in this video. The next way you can minimize your expenses and keep more money in your invested accounts is by looking at the fees you're paying. 2 different types of fees that are particularly egregious in the financial services space are the assets under management fee and the expense ratio. An assets under management fee is what a financial advisor will typically charge you to actively manage your money.
Name of the game, move the money from your client's pocket into your pocket.
And that's going to be about 1 to 2% of the total assets they manage, or the assets under management fee. As we discussed earlier, they're providing virtually no value, better than what you could do yourself, so why pay this fee at all? The second type of fee you want to look out for is called an expense ratio. This is the charge that the fund itself lays over to actively manage the investments within the fund. So someone's in there in the background, messing around, moving money around, and they're going to charge you a fee. These typically run about 0.5% to 1%. And you just really don't need to pay them because there are index funds that will minimize these fees down to almost nothing. The fund that I'm invested in has an expense ratio of 0.03% versus the 0.5 to 1% that others charge. That may not seem like a lot, but when you combine all of this, you can be paying up to 3% for really not getting any value. That's why I advocate finding a low expense ratio index fund and managing the money yourself. Now that you know which types of accounts will keep more money in your pocket and how to avoid those excessive fees, the next thing you need to do is maximize your free money. And by free money, I mean the employer match on a 401k or a 403b. This is literally money that they give you. So most plans will have something like a 50% match on the first 8% you contribute, or a 100% match on the first 5% you contribute. Talk to your HR person or look it up in your plan, but find out what that match is and make sure that your allocations from your paycheck are made to maximize that match. Now that you know what types of accounts you want to set up and that you can maximize the free money from your employer, you're going to want to diversify your investments. Diversification is really just a fancy way to say spread the risk around by holding a wide variety of investments. Now, picking individual stocks and looking at stock charts, doing some technical analysis, that can be fun. But the real way you want to invest is to buy an index fund or an index fund ETF. Index funds, rather than an actively managed fund, will automatically adjust when companies change size, they grow or they shrink, and will always hold the broadest index of stocks. That gives you automatic diversification at an extremely low expense ratio. If you like an example of an index fund ETF and an index fund, take a look at VTI and VTSAX, VTSAX through Vanguard. These are ones I hold personally. Go take a look at them, look at their expense ratios and how they're managed and their returns over time, and you'll see that these hold a broad index of stocks and they've had great returns at or better than the broader market. Now that you know which types of investments to target, the next thing you need to think about is investing for the long term. I'm talking 30, 40, 50 years. And you need to get that money in as soon as you possibly can. A lot of people say they're waiting for a dip. They're waiting for the market to drop a little bit and then they'll buy in. I'm here to tell you that timing the market is a fool's errand. The old adage goes, time in the market beats timing the market every single time. The reason you want to get your money into the market absolutely as soon as possible is because of the power of compounding interest. Over time, interest will compound on your investment. So if you put $1,000 in now, it's going to earn interest, and that interest will earn more interest, and it snowballs and snowballs and snowballs until there's a giant pot of money. Warren Buffett, one of the most famous investors of our time, has said most of his success comes from the power of compounding interest. Albert Einstein, you've probably heard of him, has a quote attributed to him calling compounding interest the eighth wonder of the world. If it's good enough for those two, it's certainly good enough for you and me. All right, with these 4 things in mind, let's get started right now. First thing you want to do is take a look at your employer plan, your 401k or your 403b, and see what their match is. Make sure you're setting it up to maximize that match. Okay, now that that's set up, you need to make sure that you're buying a broad market index fund. I personally hold VTI. If that's not an option, look for an index fund with the lowest possible expense ratio. After that, you need to look into setting up a Roth IRA. And you can do this with Vanguard or a number of other brokerages. Right now in 2022, the maximum allocation is $6,000 per year, and I suggest you maximize that. Again, drop that into the same index fund. If there's any extra money, you can look at what the maximum contribution allowable for your employer plan is and max that out. If you've maxed out all of this, congrats, you're doing really well. There's money left over after that, just set up a general brokerage account with Vanguard or some other brokerage and put the rest of the invested capital into that, and again, buy an index fund. VTSAX, VTI, doesn't really matter as long as the expense ratio is low. At this point, you are set. You can check in once a year, more often if you want, but I don't recommend it. Just let that money grow over time. Thanks for tuning in, and I'll see you in the next one.